Welcome to the channel. In this mini course we are going to talk about options trading and what options is. Before we get into option trading strategies and all the technicals, let's talk about the basic definition of options and why they even exist in the first place. So, what is an option? An option is a contract that you can purchase that gives you the right to buy or sell crypto or stocks at an agreed price before a particular date. Now, you can also sell an option contract where you would be selling this right to someone and collecting a premium for it. Sounds confusing? Just bear with me as we get through a few more definitions. Once we get through these definitions, we'll be able to show you some examples, and it will all start to make sense. Types of options. There are two types of options, calls and puts. A call option gives the option holder the right, but not the obligation to buy shares of a stock or crypto at an agreed-upon price before a particular date. And a put option is the same thing, except it gives the option holder the right to sell shares or crypto, referred to as an asset, at an agreed-upon price before a particular date. And the agreed-upon price is what we refer to as the strike price, and the particular date is what we refer to as the option's expiration date. Now, we got those out of the way, but in layman's terms, let's say you bought a call option. So, you are the option holder, and the strike price of this call option is $120, and it expires in 30 days. Owning this call option will allow you to purchase the asset at $120 anytime during the next 30 days, no matter where the asset goes. So, if the asset goes up to $135 within the next 30 days, then fortunately for you, you own a call option that allows you to buy the asset at $120, even though the asset is currently trading at $135. Now, instead of a call, let's say you bought a put option with a strike price of $120 that expires in 30 days. This will allow you to sell the asset at $120 anytime during the next 30 days, no matter where the asset goes. This is awesome, because what if the asset tanks down to $100 per share? Well, you own a put option that gives you the right to sell the asset at $120, even though the current market value is $100. So, you have a much better sale price than if you were to just sell the asset at the current market value. Why buy a put option? First, we're going to explain to you why you might want to buy a put option, which, if you remember, would give you the right to sell an asset at a certain price before a particular date. Let's put this in terms anyone can understand. Let's say you just bought a brand new car. And to protect this car, you're going to need insurance. So, you go and buy a car insurance. This financially protects your new car in case you get into a crash. And this is the exact same concept as options. Now, instead of a car enthusiast, let's say you were an investor, and you just bought 2 Bitcoin at $25,000 per coin. So, the total cost of this investment is $50,000. We all know that crypto prices fluctuate, and crypto can even go down in value. So, as an investor, you might be concerned that the price of Bitcoin could drop, and you could potentially lose a significant amount of money. To protect yourself from this downside risk, you can purchase a put option. By buying a put option on Bitcoin, you are essentially buying insurance for your investment. If the Bitcoin price drop, you have the right to sell the stock at the strike price specified in the put option contract, regardless of the actual market price. This can help limit your losses and provide a form of financial protection. For example, let's say you buy a put option on Ethereum with a strike price of $2,000 and an expiration date of 30 days. If, during the next 30 days, the Ethereum price drops to $1,000 per coin, you can exercise your put option and sell your Ethereum at $2,000 per coin, even though the market price is only $1,000. This allows you to limit your losses and potentially recoup some of your investment. So, buying a put option can be beneficial when you want to protect yourself from potential losses in the market. It provides you with a form of insurance that allows you to sell the asset at a predetermined price, regardless of how much the market value may have dropped. Of course, buying a put option comes with a cost. You will need to pay a premium for the option contract, which is the price you pay to acquire the right to sell the asset. The premium is influenced by factors such as the price, volatility, time to expiration, and market conditions. It's important to consider these factors and assess whether the cost of the put option is worth the potential protection it provides. In summary, buying a put option gives you the right to sell an asset at a specific price within a certain time frame. It can be used as a risk management tool to protect your investments from potential downside moves in the market. Why buy a call option? As you remember, a call option is a type of derivative contract that gives the buyer the right, but not the obligation, to buy an asset at a predetermined price within a specified time period. When you buy a call option, you are essentially betting that the price of the asset will rise above the strike price before the option expires. If the price increases, you can exercise the call option and buy the asset at the predetermined price, allowing you to profit from the price difference. Here is an example. Suppose you are interested in purchasing call options for a company called Apple. The current market price of Apple is $50 per share. You believe that the stock price will increase in the next 3 months due to positive industry trends and upcoming product launches. You decide to purchase a call option contract for 100 shares of Apple with a strike price of $55 and an expiration date 3 months from now. The premium for each option contract is $2, meaning you would pay a total premium of $200, 100 shares times $2, to the seller of the option. Scenario 1, stock price rises above the strike price. After 2 months, the price of Apple stock has increased to $60 per share. At this point, you can choose to exercise your call option. By exercising the option, you would buy 100 shares of Apple stock at the strike price of $55 per share, regardless of the current market price. Since the market price of Apple stock is $60, you can immediately sell the shares in the open market for $60 per share. This results in a profit of $5 per share, $60 minus $55. Considering you have 100 shares, your total profit would be $500. Deducting the initial premium of $200, your net profit would be $300. Scenario 2, stock price remains below the strike price. In this scenario, let's assume that after 3 months, the price of Apple stock only reaches $53 per share. Since the stock price did not exceed the strike price of $55, it would not be advantageous for you to exercise the call option. In this case, you can choose not to exercise the option, allowing it to expire worthless. Although the option expires worthless, your maximum loss would be limited to the premium of $200 that you initially paid. You are not obligated to buy the stock at the higher strike price since it would be more cost-effective to purchase the shares at the current market price of $53. By purchasing the call option, you had the opportunity to potentially profit from the increase in the stock price while limiting your risk to the premium paid. That covers the basics of a put and call option. We hope you now have a better understanding on how these instruments work. If you would like to see more videos like this, then please like and subscribe. Thanks for watching.